If you came into a meaningful sum of money, a bonus, an RSU vest, an inheritance, and you've been thinking about putting some of it toward your mortgage to lower your payment, you've probably assumed refinancing is the only way to do that. It's not, and for most homeowners right now, refinancing is actually the wrong move. Here's the reality for a large portion of homeowners in 2026. You locked in a mortgage rate of 3%, 3.5%, maybe even below 3% during 2020, 2021, or 2022. Refinancing means giving that rate up entirely. You'd be placing a below market rate with a significantly higher one. The closing costs in a refi are usually 2 to 5% of the loan balance on top of that. For most people sitting on those rates, a standard refinance is a losing trade, full stop. Enter the mortgage recast, and if you've never heard of it, you're in good company. Most homeowners haven't. A recast is not a new loan. It doesn't change your interest rate, it doesn't change your loan term, it doesn't change your lender. You make a lump sum principal payment, and your lender recalculates your monthly payment based on the new lower balance, stretched over the same remaining term at your same rate. Let's make this concrete. Suppose you have a $500,000 balance at 3.75% with 22 years remaining on your loan and a monthly payment of about $2,800. You receive a $75,000 windfall and apply it as a recast payment. Your new balance is $425,000. Recalculated over the same 22 years at the same 3.75% rate, your new monthly payment drops to approximately $2,395. That's a reduction of about $405 per month, permanently, against a one-time administrative fee that typically runs between $150 and $500. The so-called break-even point on that fee is measured in weeks, not years. A recast makes the most sense when 4 conditions are present. You have a low existing rate you want to protect. Sub 4.5% in today's environment is generally the threshold. You have a meaningful lump sum available. Most lenders require a minimum of $10,000 to $50,000 for a recast to be eligible. Your goal is a lower monthly payment, not a faster payoff. A recast lowers your payment but doesn't change your payoff date. If you want to accelerate payoff and keep the same payment, applying the lump sum as a standard extra principal payment achieves that instead. And you want simplicity. No appraisal, no credit check, no title insurance, no closing process. A recast is one of the most administratively simple moves available in mortgage management. One important note: government-backed loans, FHA, VA, USDA, generally do not allow recasting. Conventional loans serviced by most major lenders do. Contact your loan servicer directly to confirm. Refinancing isn't the wrong move in every scenario. There are 4 situations where it still makes sense. If you purchased at peak rates in 2023 or 2024, when 30-year fixed rates exceeded 7%, and rates have since dropped far enough to generate meaningful savings after closing costs. The rule of thumb is at least 3/4 to 1 full percentage point of rate reduction for a refi to pay off given typical closing costs. If you want to shorten your long term, switching from a 30-year to a 15-year mortgage, accepting a higher monthly payment in exchange for paying off faster and paying less total interest. If you have an adjustable rate mortgage and want the certainty of a fixed rate for the long term. Or if you need to access equity, a cash out refinance remains the primary tool for that. In any of those scenarios, always run the break-even calculation first. Divide your total closing costs by your monthly payment savings. That's how many months it takes to recoup the upfront cost. If you plan to stay in the home beyond that point with reasonable confidence, refinancing makes sense. Let me put both options side by side so the comparison is clear. A recast doesn't change your rate, doesn't change your term. The only cost is a small administrative fee. No credit check, no appraisal, no closing. Best suited for homeowners holding a below market rate with a lump sum to deploy. A refinance changes your rate, changes your term, and costs 2 to 5% of the loan balance and closing costs. It requires a full application process. It's the right tool when rates have meaningfully improved relative to what you locked in, or when you need to access equity or change your loan structure. The right tool depends entirely on your situation. For the majority of homeowners sitting on the sub 4% rates of 2020 through 2022, the recast is the more relevant option right now. One more question worth addressing. If you have a lump sum available, is a recast always the best use of it? Not necessarily. There are three main choices. A recast which lowers your monthly payment immediately while keeping your rate intact. Applying the lump sum as an additional principal payment without the recast, which doesn't lower your monthly payment but does accelerate your payoff date and reduces total interest paid. Or investing the money. If the expected after-tax return on a diversified portfolio exceeds the interest rate on your mortgage, which at a 3% mortgage rate is often the case in the long run. There isn't a universally correct answer. The right allocation depends on your mortgage rates, your liquidity needs, your risk tolerance, and how the lump sum fits into your broader financial picture. Let's close with the recap. A recast lowers your monthly payment by applying a lump sum to principal and recalculating the payment without changing your rate, your term, or your lender. The cost is minimal and the break-even is nearly immediate. It's best suited for homeowners with favorable existing rates and a lump sum to deploy who want payment relief without the cost and complexity of a full refinance. Refinancing remains the right tool when your rate is high and has meaningfully improved, when you need to change your loan structure, or when you need to access equity. The best mortgage move isn't always the one you've heard of. Full guide, including a breakdown of the recast process and the lump sum allocation decision, is linked in the description. Subscribe for a new financial guide every week. Next week, how to actually benchmark your investment portfolio and why comparing it to the S&P 500 is almost always the wrong move. Thank you for watching.